I'm going to talk a little bit of trade strategy with you today. This is called a fundamental gap fill, and it's fantastic. It's an absolute retail trap. Okay, if you're a retail trader, you probably are going to find yourself having been caught in this not just once but time and time again. Now, what is interesting is I'm not going to just show you a fundamental gap. I'm actually going to show you the fundamental gap fill as well as a technical reversal. I'm going to show you both strategies, very similar in nature, very similar in psychology as to why they occur, and hopefully you can learn. I'm going to show you the examples and then we're going to move on. So very simply, a fundamental gap fill, it can be fundamental or technical in nature. But what it does in essence, it creates a bias and positioning. So very simply put, the example we're going to talk about is the pound. It came out on Wednesday, I think it was, that the gap between the Labour and the Conservatives had narrowed to whatever, 4 points, I think it was. Okay, all of a sudden we gapped overnight. It came out very early, I think 2 o'clock in the morning, and all of a sudden the pound gapped. So we closed over here, and the next morning we opened over here. Why? Well, there's real concern. Labour's doing better than expected. Theresa May might not be the next, leader of the UK, as well as we might have a hung parliament. Okay, so suddenly we create this fundamental gap in the market. Now, that gap creates a bias. Why? Because everyone that comes in that morning is looking for short side trades only. More importantly, we have positioning, which is short side positioning. Now, the market will initially sustain and increase that bias. So what typically occurs is very early on, you get continuation of the theme. Okay, so it sustains, but it also increases the bias and the positioning. So we get even more short. So let's put a couple of pluses there, plus, plus, plus. All right, now note, the reversal then begins to play out, and we use the key trigger as the initial initiative. So when we get the second bit of initiative, the second bit of positioning going in the market, that is our key trigger point. Now don't worry, I'm going to show this to you an example in a minute. Okay. Now the key is risk is absolutely minimal in this, guys. It is a really, really good trade because it's got minimal risk and it's got unlimited upside, or at least not necessarily unlimited. Sorry, it's got a very strong upside in the sense that the gap should be filled or the stop should be unwound, whichever comes first. Okay. Now I'm going to show you this fundamental gap in terms of the charts. So what you got here is the pound on Wednesday when we had that announcement out. As we can see, we have the gap up there, a nice aggressive gap in the market. Okay, this is now very early hours, so we can see the market just drifts, it drifts, it drifts, and all of a sudden, we come in the next morning, it's the European session, and we get a little bit more of the sideways trade. And all of a sudden, on the cash open, we can see that initiative being taken with a very big upsurge or very big uptick in the volume. So we can see sellers stepped into the market, big players stepped in, the volume picked up, and we started to take out key technical areas, and the initiative continued. So one, we've got our first bit of initiative on the overnight gap, and then two, we get our second bit of initiative as well as an increase in the positioning. Okay, now that becomes a really key pivot in the market, that point at which that second bit of initiative occurs. Why? Because if this is a big fundamental, the market should never ever get back above that initiative. It's almost as if saying, if a market's going to reprice itself, there is no way in hell that if this is real, the market should not get above that point where the sellers stepped in to take the market lower. Okay, because if sellers are selling it because Labour is narrowing the gap and this is really big and this could be massive, we will never ever get back above that point. Maybe a couple of days or months or years later we might, but not on the same day. Okay, so straight away when you get that second bit of initiative, we can see that the short positioning picks up. Now note, the market continues lower. It pulls back, it respects that initial swing low in the morning, hovers, hovers, hovers. By the way, this is a 5-minute chart. It comes back to that initiative point. It hovers for a little while. And all of a sudden, we have a complete unwind. Okay, now, what I'm going to show you is I'm going to show you what this unwind looks like in terms of price action. Now, the key is what we're looking for is once we come back to that initiative level, we have to be switched on and say to ourselves, we should not be back here. The minute we get back above it, we are looking for long side trades to fill in this gap or once the stops unwind. And we can see those stops unwind because why? 4,000 contracts suddenly spike and price very volatile up towards the upside stops everyone out. So we're exiting up here, we're entering in here, and we're keeping our stop nice and tight just below where that previous swing low is. Now, I'm going to show you what this looks like on a footprint chart, and I'll tell you why. Okay, a footprint chart is like trading on the price ladder. Okay, the price ladder allows us as traders to pick up on, the buyer and seller interaction. Now, if you don't execute on a price ladder, you should be executing on a price ladder because you get perfect price execution, but you can also see the nature and interaction of buying and selling on the market. Okay, so yeah, we have it. We can see that this is now when the second bit of initiative occurs. So we can see the market comes below that area of 128.15. We then get a little bit of a pickup in the volume. Okay, and the market sort of has a little bit of an offer low. It comes back, retested one last time, and the sellers step in and very aggressively not just move in terms of price and volume, but also in terms of delta. So they show real aggression, and the market very aggressively moves towards the downside. Okay, so there's our second bit of initiative. There is our key level at 128.50. Now, let's have a look what happens when we come back to that 128.15. So there it is, nice blue line. Note the first time the market respects it. Okay, so the market respects the fact that that's where sellers initiated, that's where they're protected. But what happens once we get back above it? Again, note the pickup in the volume, note the pickup in the volatility. The market sort of scales above it, comes back, and what does it do for the next 15-20 minutes? By the way, each one of these represents a 5-minute time rotation. So the market then spends the next 20 minutes inside a sort of 5 to 10 pip range, accumulating, allowing anyone short the chance to get out. Equally, it allows anyone that's switched on, anyone that's watching this closely, to enter those long side trades, to get long the market. Okay, and once the market is, pretty much spent that time accumulating, we then get the rotation higher and the ultimate stop outs, which occurred around 11.25. Okay, so very important, guys. The crux to this trade strategy is not that you have to preempt. Okay, you don't have to be buying it here, preempting that it's going to get above it. Right? What very typically occurs when there's a fundamental bias in the market is that as prices start to move higher, guess what? There's a lot of people that are still selling it and selling it and selling it. Why? Because Labor's narrowed the gap. Okay, all they're hearing on social media is that Labor's narrowed the gap. All they see on the charts is red candle. Okay, so all they want to do, regardless of where price is sell it higher and higher and higher. And it's that selling above the key point that eventually creates the catapult. Equally, it is that selling that gives us the opportunity to get long as we like and be on it for the break higher. Okay, that's what a fundamental gap reversal looks like. Now I'm going to show you what the technical gap looks like. Okay, similar concept. Very, very similar. You get the positioning, you get the market being too aggressive in one direction, and you get the reversal. Now, again, another market you all know, this is the Emini S&P500, okay? Now, we spoke about a wonderful strategy last week, which was the breakout strategy, and we spoke about how so long as we maintain that gap, the breakout is on and markets should extend. Now, what occurred is we had a very, very interesting point at 2407.75, okay? And this is what we call a technical reversal. Why? Because it was a double bottom on the dailies, okay? And once we got below that double bottom, note the red line. So once we got below that 2410.25, notice the initiative. So again, these are 5-minute candles. Notice the size of the candles as well as the aggression of price. Equally, notice the very aggressive pickup in volume. Okay, so we got the initiative. There's our initiative leg. We then got a shallow pullback, and the market sat there for the rest of the day, showing us that technically this market is now weak. It's taken out a key area. There's a lot of initiative in the market. There's a lot of short side trades that are entering and holding this market for a continuation towards the downside. And shock horror, we get back above that key level. The market, notice what it does. It sits again for 20 minutes, sits above the key level, and then guess what happens? We get the unwind. Okay, so again, very similar strategy, except this time it is a technical bias that is in the market. In other words, once we broke that 2410, traders only want to be short, and it's that sort of bias in the market that creates the reversal in the opposite direction. Again, look at the footprint. Okay, if we notice very carefully, we saw the initial move starting around the 24.12. That's where the seller stepped in quite aggressively. He took the market lower. It then came back and retested that 24.11, the key initiative point, before then moving a lot lower. Note the pickup in the volume, as well as obviously the pickup in the delta, showing us the aggressiveness of these sellers. And guess what? When we came back to that 24.11, notice how the market respects it first time. It then sits there just above the level for 20 minutes, allowing us to be long the market. Get long, why? Because everyone else is still stuck in a technical short bias. Once it gets above it, we then get the move towards the upside. Okay, and surprise, surprise, in terms of the stop outs, if we go back to that daily candle, note the real aggressive stop outs didn't actually come that night. It came the next day once we scaled the previous day's high. That's when we got the very aggressive unwind towards the upside.